Hello there. Uh, okay, this is one more video on the issue of 401k, and I hope to wrap the whole thing up with this video. You know, if you if you got to this point, you know, I congratulate you because I'm not a good speaker or anything, you know, and you have to ready to go to get to this point. You need much patience. But in any case, let's try to finish it up. Okay, so first of all, we have covered, maybe in the first of our meetings, I covered the issue of risk assessment and leverage. So basically, I would say that if you are not taking advantage of leverage today leverage is available in many ways. You can always find a way of putting together a portfolio. You can do it in a way that you take advantage of the leverage thing. And if you are not using leverage, it means that you're using leverage equals to 1. And I bet you that it is virtually impossible that this is what you need. In other words, if you have a very good, very, let's say, down-to-earth assessment of your risk profile, you'll find out that with leverage 1, either you are missing opportunities in the market because you're playing on a level, in a risk level, which is much, much lower than your actual risk profile, or the opposite, that you are being too risky for you're being too aggressive to your profile, and you may, you know, something may end up getting very wrong. Okay, so we talk about leverage and, you know, and try to match leverage with how much you know about your risk. And then I said that if you want to learn more about risk, you know, take the class, the project management class of the Irvine University, which, you know, has a whole package just on how to evaluate risk, and of course other sources. And the next, I went on, I'm sorry, to talk about, oh, I'm sorry. Okay, next I went on to talk about what is beta return and alpha return. And of course, the beta coefficient. And just making a very quick, say, abstract of what we discussed. You have to see that, you know, you must know those, you know, when you create your portfolio, or even if you just stay with the funds which is offered by Fidelity, or if you try to, like, if you try to go to buy and sell stocks, which our program, our system, our saving system with Fidelity allows you to get to put your 401k money on stocks. You know, you can pick stocks, you can go to ETFs, you have all types of ETFs and etc. And something that, you know, I dare say that if you know a little bit about the market, you find out that you can do better than the funds that are offered by Fidelity, unless you are sticking to the S&P 500, which is a very good option, no doubt. You know, which is, you know, Warren Buffett's advice. But even if you stick to the S&P 500, you should consider leverage on top of S&P, because maybe S&P is not risky enough for you. So you should, you know, jack up your leverage, or maybe the S&P is too risky for you. And in this case, you know, you have to lower down your leverage. Okay, and then, so I said about beta, alpha and beta, and you may remember that beta, basically, it is the use of leverage. Now, you know, embedded in your fund or in your portfolio, you're using leverage. And so alpha is the additional return that you're getting which doesn't depend on leverage, and it depends on how smart the manager of that specific fund, how smart he is in picking stocks or picking opportunities or stocks or whatever other type of investments. This is alpha. Now, the difference is that beta, okay, suppose that your fund has a beta times 2, a beta coefficient of 2. So if the market closes a year with a 10% return, you're going to have 20%. If the market goes to 15% return in a year, your fund is going to yield how much? 30%. But surprise, surprise, if in a certain year the market has a correction of 10%, so you have a loss of 10%, what happens to your fund? You're going to have a loss of 20%. Okay, leverage, all it does, it just multiplies whatever the market does. Okay, so you may want this or may not want this. And this is something that, you know, if you go to even Fidelity or any big company, it can be Schwab or anyone, and then they offer you all those nice, okay, those nice funds, and they show you the result, how they return in the last 10 years. Well, you know that in the last 10 years, the market only went up. So if all this company did, you got your money for those 10 years, and if you put in a ×2 ETF for the index, you're going to have twice, every year, you're going to have twice the return of the index. But is this a good fund for you to put your money? Well, it's up to you, because if it is 100% beta, what's going to happen? The next year, if the market loses 10%, you're going to lose 20%. So there's no expertise, there's no smartness in picking anything. All that you're doing is just putting in an investment that doubles whatever the market does. Okay, and as I said, you can have today you have tens or 100 ways of doing this. Applying leverage. And so that's really. So, okay, let's just make a quick comparison on both ends. Let's assume that your portfolio is 100% beta. So like I said, it's good because if it doubles what the market does, the market has been doing positive the last 10 years, and it's doubling the positive. That's good. But you have to understand that if it's 100% beta, if the next year, if the market goes down, it's going to go twice as bad. While if it is, let's assume that you have a certain portfolio that is 100% alpha. It doesn't exist such a thing. You don't have 100% alpha. But if you have 100% alpha, it means that it is totally independent of the behavior of the market. It means that regardless what the market does, it's supposed that it delivers 20% every year. So see the difference. It is an additional. Normally, if you have a beta of 1 and some alpha on top of this beta, you're going to have whatever the market yields plus 10%. So plus 10%. So if the market yielded in that year, if the market has a loss of 10%, your portfolio will result in 0, plus 10, minus 10. Of course, all that we're saying and we're doing, we're making the assumption that specific portfolio will keep behaving the same way that it has behaved over the last 10 years, or whatever the time that you use to calculate your alpha and your beta. Okay, so nobody knows the future. But the issue here is that if your portfolio keeps doing more or less what it has done on the last 10 years, so it's going to keep the same alpha, the same beta. So you're going to get the expected results. Now, this is something, an aside that I would like to, before we go for the next item. What I would like you guys to know is that be careful with small or big financial companies, because, for example, like I said, you have if you go to our Fidelity, and they have the list of the funds, and they show what was the return of the funds in the last 5 or 6 or 8 years. It doesn't mean anything. Of course, I mean, unless they came to me and they say, hey, this is my alpha, this is my beta, it doesn't mean anything. And besides, even if they come to you and they say, okay, my beta is so much, and my beta coefficient is 1.5. I'm going to ask him, how did you calculate it? Because you have many different, you have many ways of cook your calculation and make the result that you want. So ideally, what you could want is, okay, give me the raw data, give me, how this specific portfolio, how was its closing cost every day for the last 10 years. And then I will compare with the S&P 500, and basically, how do I get the alpha? How do I get the beta coefficient? I got the beta coefficient comparing the volatility of my portfolio with the volatility of my benchmark, which in the case is the S&P 500. So if I had the raw data of both of them, and besides, it is more complicated than this, because you can calculate for every 6 months, you can calculate for every 1 year, you can, you have many different ways, and then you will come up with a meaningful number for your beta coefficient. So the first point that it's very misleading is that if you don't know, of course you can say, okay, I'm going to go to this one here because it yields more. Okay, so just and besides, those companies, big and small, unfortunately, they have many ways without telling you a lie. They have many ways of to lead you to understand or to believe something which is not true. For example, very common they do this. For example, that they in the beginning of a certain year they open 4, 5 funds for emerging markets, and they just randomly they use 4 criteria to manage those 4 funds for emerging markets pretty randomly. So what happens is that after 1 year, suppose that one of them was very bad and the other 3 were good. So what they do, they drop the bad one and they tell the clients that it was dropped, but please move to this other fund. Many of them will do it. So 1 more year, the one that performed badly, they drop it. So basically, it's just like, if you, so you had 6 funds, just by randomness, in 6 years, you're going to have one which performed above the average, with no expertise, with no knowledge, no anything. And what they do, they keep dropping the ones that don't perform very well. Like after six months, they have only 1 fund for emerging markets. And they say, look, I have such a good return this year. It was totally just like throwing a dice, and you throw a dice 6 times and you choose the best of your bets, and you just throw away the other ones and say, see how good I am. So, it is, I don't know how to do, because, and besides, if the same company, Fidelity, that does that to you, will direct you for a number of financial counselors, financial advisors. And my experience with financial advisors was not good. I know some of them are honest, but they don't know enough. And there are the other ones that on top of not knowing enough, they're not honest. Okay, so that's the second point that I'm talking about, alpha and beta. Now, let's talk. The third thing that I covered was how is the market in the post-Warren Buffett era. We are in the post-Warren Buffett era, when he was able to convince that all the mutual funds And all the hedge funds in this country, I'm not saying all, but most of them, are just, are just a hoax. You're getting less in the market. That's basically what they did. And when they did it, when he proved this after a bet of 10 years, for to have an idea, at that time in this country, we had about 8,000 hedge funds. After this, the bet was finished in that year was 2017. From 8,000, only 2,000 hedge funds survived because, the money just went away. People don't, and since that time, of course, I'm not saying that it's total, you still have, many hedge funds and, but the fact is that, that idea that you had that you have those smart people and those smart people are making more money than a regular fund or the regular index, this idea, doesn't hold anymore. Since then, we also mentioned what is called today is called the smart beta. So basically, these people, those hedge fund people and mutual fund people, to attract this money back, they said, okay, we are not good in creating alpha, that's fine, but let's do something a little different. One of them is what they call, private equity, which I don't want to talk about. If any of you guys wants to know more what private equity is all about, we can discuss. It is not, it doesn't have the index as the benchmark. So it's, you have to understand quite well what you're doing. Otherwise, you may have some unpleasant surprises. And then the other thing that they came up with, it's called the smart beta approach. What got the name of smart beta? It's like this. Okay, the S&P 500 is the best investment ever by Warren Buffett. So let's do one thing. Let's analyze the S&P 500 for the last 18 years, for the last 70 years, since 1950. And let's see what happened. We had 18 recessions during this period. So let's split those 500 companies that make up the S&P 500 fund index. Let's split it in two factors. What do they call factors? For example, the size of a company is a factor. So I'm going to divide those 500 companies in 10 chunks, from the smaller to the bigger ones. Okay, and then what's the other factor? The management style. So let's get all those companies, see the ones that use a traditional management style and the one that use some other type of style. And let's also see the ones that had that all the time had a balance, like liabilities and assets in a certain level, and the other ones that they were more risky. So, they created a number of features that they called factors, and they tried to see within those features in those 70 years, how each one of those factors behaved during the 18 recessions. So they may find, for example, that typically small companies, they in a recession when the market went down 30%, and the small companies only went down 20%. So basically, these are the two things that they try to analyze. How it okay. So they're just comparing the behavior of the plain index with those factors. So how much in each of those recessions, how much the market went down and how much the factor went down. Of course, if it is a promising good factor, it went down less than the market itself. And besides, how much it took for the market to recover and how much it took for that specific factor to recover. And by doing this, they ended up creating portfolios, which is basically the S&P 500, but now the stocks, they are weighted in different proportions, so that you have more the good factor ones, like if they find out that the small companies don't, don't correct as bad as the whole index, they are going to put more, a bigger weight for the small companies. If there's this type of, they try to create portfolios that would perform more than, at least that did perform better than the index on those 18 events in the past. Okay, so it's not alpha because nobody's picking, nobody is using his expertise to picking better assets, that has a better return. They're not doing this. So they ended up calling this a smart beta approach. Well, this thing started more or less in 2017. And the result of this is questionable. Okay, questionable because most of them, they have been more or less, performed just like the index, a little bit better, a little bit worse than the index. But the smart betas people said, oh no, because we didn't have any negative year since it started. So basically they're saying when we have a negative year, you will find out that it's going to go down much less than the index. So that's why, so it's safer than the index or something. It's very questionable, very questionable. But this is one thing that this is one thing that became that it's kind of something that it is the fad today. There are many what used to be hedge funds, now they offer smart beta portfolios. Okay, now I'm gonna that's what, I'm talking about what we have already discussed. Now let me go to the next point then, to the next item, which we have for today, which is my approach. Like I told you guys, and I've been saying that over the last 12 months, in my 401k, I had a return of 60, now it's 63%. If you get the last 12 months starting from today, back from today, you have 63%, and how is this possible? So let me tell the strategy that I created. In a nutshell, it's not easy to to compress the definition, but let me put it this way. When the market is, suppose that I have a year that closes with 10% positive return, what my portfolio does, it returns with 20%. Why? Because I'm using a ×2 S&P 500 ETF. So I'm just using my beta equals 2. If I have 10%, I'm gonna get my portfolio is gonna go 20%. If I get 20%, my portfolio is gonna go 40%. So we know that more or less in 1 year we're getting something between 8% and 12%, and I'm always getting the double. Okay, but what's the problem with what is the problem with beta equals 2? Of course, it's when you go to the other side, to the bad side. So with my strategy, if the year ends and wraps up with a loss of 10%, my portfolio ends that year with a loss of 20%. Wow, that's bad, isn't it? Yes, it is. But well, what am I doing? I'm still down to 10% of loss. I'm still, all my money is just in this ×2 ETF. Again, beta equals 2. If the market went down 10%, my portfolio is going to go down 20%. But here, you have a difference. That at this point down, according to the magic sauce that I use, I start to buffer my loss. So if the market goes down 10%, my portfolio went down 20, that's bad. But then if the market goes down 20%, my portfolio only goes down 25. Okay. And if the market goes down 30%, my portfolio also goes down 30%. And with the market at this point keeps going down, my portfolio is going to go down practically the same as the market. All right. So let me put it this way. There's a kind of a safety net. Okay. When I go in the negative, I have a safety net. I have a buffering system that in the very beginning, my beta is still 2, so the market goes down 10, my portfolio goes down 20, beta equals 2. But if when it goes to from 10 to 20, mine is going to go to 25. My beta is somewhere between 1.5, 1.4. And if the market goes down 30%, my beta is also 1. My beta, I'm talking about the beta coefficient. So the first thing, which is not very common, and it's I had some trouble, you know, I have been discussing with some professionals in this area that have been presenting it. And some people, they don't understand because they ask me, what's your beta? I say, well, my beta is not a number, my beta is a function. In the positive side, my beta is 2. On the negative side, if you are between 0 and 10, a loss of 10%, my beta is still 2. But from a loss of 10% to 30%, my beta is going to keep going down and down and down. When it gets to 30%, my beta is 1. And if the market keeps going down, my beta, my portfolio will just go down the same as the market. So that's what it does. Now, the question is this a good thing? Is it a bad thing? It is too risky. Okay, it totally depends on your risk profile. And I'm going to tell, as I said, I've been sending this idea to many managers. Some of them are even famous people. Some of them, or most of them, didn't answer. Some of them did answer. And this guy from Switzerland, from Zurich, he is the one who got interested and asked me to explain, and I tried to explain, and then I ended up going on the phone and talking to him until he just got it. You know, not only what I was doing, but he wants to get into the, you know, into the how do you get that? You know, how do you? And I showed him how I do and how I you know, how I pull off this, you know, this approach. And I asked him, what do you think about it? He said, well, it depends on the risk profile of the person who you use. And I said, okay, but would you present something like this to your clients? He said, no. I said, why? He said, number one, he said, my clients are big companies. So a person that I present something like this are the finance professionals in this company. And they will be able to understand if I explain to them. But, you know, they have to close every year. And he has to present the results of that specific investment every year. And it's very difficult for you to convince the board of a company, if you are the finance person, that the market went down 10% and that your portfolio went down 20%. So they will not do this. Let's imagine the Stanford here has $500 million that is in a savings account of Bank of America, and they need to put this money somewhere because they will be using this money only within 10 years, because in 10 years they'll be building a new campus. So they hire a financial guy, and the financial guy will go out and try to where to put this money for those 10 years. Now, normally he will not put this money in an investment that can lose twice the market in the end of a fiscal year. because it's very hard for him to comment that, oh no, you know what? Because basically, okay, let me tell you what I've been doing with my applying my strategy to the past. Okay, like if I used my strategy over the last 70 years, what I get is that every 10 years, typically S&P 500, every 10 years, it doubles. Every 10 years, you have not really doubles. It gets something like a 90% return in a period of 10 years. With my approach, any 10-year chunk that you pick, you get a return of about 800%, 8 times, 7 times. And instead of doubling twice, doubling it, you're getting it, 7 times more money. So it's good. Well, of course, it's good. But as I said, suppose that you put the money there, and suppose that the next year that the money is there, and that's in the first year that the money is there, the market corrects 12%. And you have to go back to your board and tell, well, my investment corrected how much? 22%, 23%. It's normally he won't do this to other people's money. So this guy, my friend, even forgot his name now, the guy from Switzerland. He's not from Switzerland, but he lives in Switzerland. And then, so he said, okay, there's the other type of clients that I have. Who are the guys that have the money, but they don't understand? Now, it's almost impossible for me to show to this guy that this is a good investment, because if it took me about a week until I understand what you're doing, it's much more difficult for you to explain something like this to a person who's not in the finance area than, for example, the smart beta, the factor-based smart beta. It's very easy for you to explain the factor-based smart beta. Okay, so he said, the person that he said, I will not put the money of this guy in an investment unless I'm able to explain to him exactly how the thing is supposed to work. So he said, and then he said, okay, the only people that would be interested in an approach like this, who are the guys who understand a lot of finance and that they have money to invest. But then he said, well, but this type of people, they never come to me. They don't need a hedge fund. They invest themselves. So this guy, he said, I would be interested in using your approach for my own money, but I would not try to put it down there because, especially because the other thing is that all those companies, you have to report your things within a certain fiscal year. Okay, it's different from a 401k because you don't care. I mean, you don't have any goal of like within the next 12 years I have to reach so much, because first of all that you don't pay tax on your 401k. So that's what he said. He said, look, you may find other people, other groups, especially 401kers, that they have a certain risk profile. In other words, I know that if I'm talking about a period of 10 years, I'm going to have a return which is much, 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 much higher than the plain index. Okay, unless something, I mean, I'm assuming what Warren Buffett assumes, that the market will always go up. Okay, I'm just making the assumption that the whole world makes the same assumption, that the S&P 500 may have those big drawdowns, but the trend will always overcome. The trend will always go up. And if the thing keeps going, with my approach in 10 years, I'm going to get 10 times more return than the index. So it's not bad. But so if you have a person that has this type of goal, and if it is a person that he has a certain tolerance for the risk in the short term, like he won't get desperate if the guy next door only lost 10%, if he lost 20% in that specific year. If he has this type of risk, okay, he said it is a good approach. And then the second thing, and I was even hesitating if I should bring it up here, but because it's a little bit more technical, a little bit more like mathematical, but I will. Okay, that's basically, okay, with the thing that I just did now, I finished this presentation. Now this, what I'm gonna say from now on is a bonus. Okay, here's the point. He said to me, and something that I, I had not, I had this idea, but not as clear as he said. He said, okay, the good thing about your approach, he said, when you create a smart beta portfolio, what do? You go back in the past 70 years, you locate the 18 recessions that we had, and then you evaluate how the index behavior is in relation to the factor behavior, that specific chunk that you, and then you keep doing. But he said, what's the problem with this? You know, okay, today everybody knows algorithmic trading. Everybody knows how to use statistics for this type of evaluation. So the problem is that you will be analyzing 18 events, 18 occurrences. Now, you know that for any type of a meaningful, statistically meaningful conclusion, most statisticians, they say, if you do not have at least 36 events in a population, you cannot trust your results, okay? You cannot trust your results. 36 is a kind of, at least for example, for you to determine the normality of a distribution, if you have less than 36 events, you can't. I mean, you may get, oh, it's perfectly normal, but you don't have enough information to get into this. So basically what they're doing, even if they can prove that in the last 18 recessions, the factor that they're choosing behaved much better than the plain index, it's not enough. Statistically, it's not enough to see that, okay, is a trend. You know, it's not enough for you to trust on your extrapolation. If you have 36 something, you know, it is much, you know, your level of confidence goes up. And then he said, okay, in your case, the thing that you're doing, you're not comparing the behavior of two entities. You don't have two variables. Because the problem is this. So, okay, what I can do with my stuff, I can, on top of analyzing my approach in the last 7 years, I can randomize the results of S&P 500. You know, I create, okay, let's just, you know, randomly, let's put it there. Like, so I create a fake S&P 500 for the next 70 years, totally random. And then I run my stuff and I see how it behaves. Okay, run them again and run it again. Run them again and run it again. And if I do this several times, and then I can even, you know, like customize. Okay, what if the index went up and then down, and then had a second down and then went up again? And if I was using my strategy, what would be the result? Okay, I can do that because I have only one variable, which is the index itself. Now, when you have two variables, and those two variables, like the behavior of the index and the behavior of the factor, they are dependent. You know, you cannot just randomize one and randomize the other one. It doesn't make a bit of a difference. It doesn't make a bit of a sense because, you know, you have a correlation between the, so it's okay. So if I'm going to correlate, I wanted to randomize the index. Okay, so I can have more recessions, and then with those more recessions, I can make my analysis. And I cannot randomize both because they are dependent on each other. So, okay, I'm going to randomize this, and then I'm going to make the other one based on the correlation between them. But then they said, okay, this is the correlation, the thing you don't know. See my point? I mean, all you know is what you were able to extract from those 18 events or the 18 occurrences. And if you're using it to randomize the other one, of course, what you're going to get as a correlation is what you already did. So that's the big difference. You said, okay, all the factor smart beta portfolio, the level of confidence is very low. The results are perfect because, you know, when you make the analysis and you pick the factors in a certain, the right way, they say, okay, what can you expect? Okay, expect is going to be better, always better. Okay, but the level of confidence is very low. You know, I mean, how much you can trust your analysis in order to extrapolate is low. And then another guy told me, your approach is the opposite. When you make all your simulations, you'll find out that your approach sometimes is better, sometimes it isn't. Okay, so that's why it will depend on the profile, on the risk profile of the investor, because you're saying that if this and this and this happens, you're going to lose 20%, while the rest of the folks will be losing 10%. But then you're going to show, okay, the other thing is that, like, if you pick the last 10 years of the S&P 500, and if you see how many months it was correcting and how many months it was going up, you're going to see that from those 10 years, maybe you'll be able to get 8 months going down, and the rest, it was always going up, okay, typically. So it means that when you go down, you know, your portfolio is going to go down faster, but it's not going to be a disaster, because suppose that you have a bad recession like you had in 2008. Okay, that the market went down 56%. The market went down 56%. If you were using my approach, you would have gone down 54%. Because like I said, you know, more or less after 30%, my approach doesn't go down faster than the market. It will keep going 30, 40, they will keep going, and, you know, of course, with a certain difference. Specifically for the crisis of 2008, if I run my program with my portfolio, the market corrected 56%, and my portfolio would have corrected only 54%. Okay, because as I said, above 30, 32 something, it will keep. So, okay, so what I'm saying is that in a period of 10 years, you have maybe 8 months that the market went down. And besides, take a look at the chart of the S&P 500. You'll find out that every time that it corrects fastly, goes down very fast, and then takes a long time to come back up, and then goes down very fast. So all the times that is going up, my portfolio, you're gonna get twice. It's gonna be, I mean, whatever, how much it's going up, my portfolio is going to doubling, because I'm using an ETF times 2. So, unless the market and S&P 500 changes its behavior in a very unexpected way, okay, something crazy that never happened before, that you keep going down and down and down, a little bit up and down, 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 something that never happened and nobody expects. Unless something like this happens, you know that in a period of 10 years, you'll be profiting 700% against 90% of the plain index. But this is good. If you have a certain profile, a certain risk profile that for you is no big deal, that you're going to have a period that you are going to be losing 20% of your money at the same time that the guy next door will be losing only 10% because he invests in the plain index. and you are investing in this special portfolio. If this is something that, I mean, if you have the tolerance of waiting, suppose 5 years, even if this happens, even if you have several recessions, one after the other, according to all the what if analysis that I did, putting the index up and down, going up and down, even if you have several recessions, in a period of 5 years, you will always be making much more money, I say, at least in the worst of conditions. Most of the conditions. In 10 years, let's assume that the S&P 500 yielded 50% in 10 years. With this portfolio, you'll be making 200%. Okay, but of course, it depends on your risk tolerance, because for some people, a local loss of 20% relative to that you could have lost only 10% may be a great deal. So that's why you have to understand what is your tolerance risk. And of course, the same that happens with S&P 500. If you see Warren Buffett's counseling, okay, and his recommendation, he says that if you want to transfer stuff into the S&P 500, you should not just move your money immediately. The whole chunk is here, and I'm going to put the whole chunk here. Why? Because suppose that the day that you decide to do this, suppose if it is the very day when recession started. So you have $100,000 and say, okay, I'm going to put everything on the S&P 500. And then this very day, the recession starts. So it's going to mean that from those $100,000, we think that is a recession of 50%. So in about 1 year, from the 100,000, you're going to have only 50,000. So what he does, what Warren Buffett says, okay, you put a little bit and wait it to go up. Wait it to go up at least a little bit. So now you made a certain return. Now you put some more. Okay, you put some more and wait it to go up a little bit more. And if it starts going down, keep it there. The way that you make this transfer is very, very important, because you don't know at what point the market is right now. For example, it's been already 10 years that all the soothsayers, all the negative, the pessimists say, oh, the market is in a bubble. It's going to have. It's been 10 years and it didn't happen. And then when the COVID crisis started, the same thing. Oh, now it's going to happen. Now it's going to be, it's going to be the end of the world. No, it wasn't. But what I'm saying is that since if the market has been such a nice stuff for 10 years, the more the time goes by, the more nervous everybody gets. So, don't transfer. If your money is not in the S&P 500 already, don't transfer it in a chunk from here to there, because they say, some people, not everybody, but some people, they say that sooner or later something, a recession is going to happen. While the other people, they say the opposite. They say, no, an uptrend never dies of old age. If nothing happens, it keeps going. There's no such a thing of expecting that every 10 years is going to happen. No. Okay, in any case, it is safe if anybody wants to get into the S&P or to get into my approach, it should be done, little by little, little by little, like, 10%, and transferring little by little, because unless your risk tolerance is such that you get all your 401k and you put in something like this, and then it drops 50%, okay, and you get this huge, but that's not the wisest way to do. Okay, one more time. I'm just a disclaimer. When I say that I'm available to help you guys, whoever wants to use this approach, at least, like somebody, he came to me and said, well, I'm going to do it because it seems to be interesting. I'm going to put from my whole 401k, I'm going to set aside $2,000, and I'm going to do what you're telling me to do with $2,000 for 1 year. Let's see what comes out. Very good. That's perfect. The disclaimer is this, okay, I'm not doing this for any type of profit. I'm not doing this for any type of, I don't know, you know, it's not a consulting service. It's not, like for say, the patent, you know, the idea, or none of that, none of that. The reward that I receive from that, you know, is to have people to talk about it. Because as I said before, you know, this type of activity ends up being a very, very solitary, very lonely thing. So, you know, that's the only reward that and basically it's very easy because Fidelity does everything for you. Okay, you can go to the Fidelity. You have, I don't remember, I said APCH, I don't remember. They have in your 401k, you can open this, it's a platform in that you transfer your money to this, from the funds into this HPCH, I don't remember the name. And once the money is there, you can buy and sell stocks from the New York stock and NASDAQ. And I mean, all the big exchanges in this country. You can buy ETFs. And like I said, you have 2 or 3 or 4 times 2 ETFs in this country, okay, which is a S&P 500 times 2, which are the ones that I've been using. And maybe the last thing I want to tell you is that, okay, like I said, some people kept asking, well, how can he have made 60% with the index in 1 year? Well, very simple. If you see, you know, from the depth, the worst depth of the recession we had in March of last year, you know, after the COVID, the market just dropped. And if you see where the market it is today, you're going to see that we had, you know, an uptrend of more or less 32%. What did I get? It's basically this times 2. You see, I mean, there's no mystery, and there's no expertise. There's no smartness. There's no smartness, you know. It is just, you know, since the very bottom, all my money is in this ETF times 2. So, you know, so whenever the market had this return of 30%, my return was 62%. Okay. The downside, like I tried to explain several times because I don't want you to get the wrong impression. The downside, of course, is also there. Because, you know, if it had gone down, my system goes down twice as fast. But there is a safety net. Only goes down twice as fast until 20%. If the market keeps going down from 20 to 30%, mine will keep going, and then it'll end up when you get to 30% loss, I'm going to be equal to the market. And if the market keeps going down, you know, my system will just go down the same as the market. Okay, so that's the way it does. Like I said, it's up to you guys. If whoever wants, you can go ahead and open this PCA or PCH, I don't know, in the Vanguard. You must call the guy. And then you must call the Vanguard. He said, no, Fidelity. I'm sorry. Fidelity must call the guy, and they do this, and then you can transfer money to this platform. And maybe because you'll be using a times 2 ETF, they may ask you to sign something like an affidavit or something, because at least they want to know. They want to make sure that you know what you're doing, because, you know, as I said, it is very aggressive. It is not a common ETF because it's going to yield the double of the market, but it will also lose the double of the market. So they may need you, you know, to factor that. something that you sign telling that you are aware that this is a special product that you may incur in major losses and etc. But this is something that you do from your desk. Uh, Very simple. I mean, it is a standard for the Fidelity 401k. And once you have this set up, you tell me what you want to do. Like I said, I would not encourage anybody to make a big transfer like from here to there. But maybe, just for giggles, put $2,000 there and see what happens. Or if you want to still be even safer, put $2,000 there in chunks of 500. Because if you put 500, this starts going down, stop. If it goes up, if you notice that you gain maybe 600, you put some more. We guys, we are engineers, okay? So we know how to figure out, what's the best way for you to do something like this. So I believe that this is the last video. Few people, three people have already, showed interest. And okay, one of them is Peter. Peter went much deeper. That he tried to dig into, the algorithm that I use to do what I do, which is also open, guys. Okay, it is open. I mean, if you guys want me to the whole thing is in a spreadsheet, in a Excel spreadsheet. If any of you guys want to get into how do you pull this off, but ask Peter, because what I noticed that what happened to Peter, is maybe it's a little bit more complex than he was expecting. I don't know, but it's open, it's totally open. And besides, if you want to go that deep, I would be very thankful, because there are so many opportunities to improve. I have in my to-do list, I have about 10 other people that I should investigate, and that I know that there are, room to improve the approach. So that's basically it. Okay, if you guys are interested, please call me or send me an email. And that's all I want to tell you. Bye-bye. Stop recording.